This is a $100 bill. Benjamin Franklin's face, that familiar green ink, the weight of cotton and linen in your fingers. Feels substantial, feels real. In 1990, this bought $100 worth of goods. Today, adjusted for official inflation, it buys $42 worth. Seems bad enough, until you realize the official numbers are designed to hide the true erosion. At 2:15 p.m. Eastern yesterday, the Federal Reserve announced quantitative easing 6, $240 billion per month in asset purchases. Not $60 billion like QE3, not $120 billion like the pandemic response, $240 billion, every 30 days, for as long as conditions warrant. That phrase, as long as conditions warrant, is Fed language for permanent. They're not telling you it's permanent because permanent sounds terrifying. But the math only works one way. This is not stimulus. This is not crisis management. This is the Federal Reserve announcing that it will print $2.88 trillion per year, indefinitely, because the alternative is immediate systemic collapse. The hyperinflation phase hasn't started. The hyperinflation phase was announced yesterday at 2:15 p.m. Most people just don't know how to read the announcement. Here's what they're not telling you. The QE6 announcement wasn't scheduled. Federal Reserve policy decisions are supposed to occur at FOMC meetings, 8 times per year, on predetermined dates. The next scheduled meeting was February 4th. Chairman Williams called an emergency session on January 21st and announced the decision the same day. Emergency sessions happen when something breaks. March 2020, pandemic shutdown. September 2019, repo market seizure. September 2008, Lehman collapse. The pattern is consistent. Emergency sessions mean something has failed that cannot wait for the normal policy calendar. What failed this time wasn't a single institution. It was the Treasury market itself. On January 17th, the Treasury Department attempted to auction $58 billion in 10-year notes. This is routine. The government auctions debt constantly to fund operations and roll over maturing obligations. Auctions have occurred without interruption since 1929. This auction received $31 billion in bids, a coverage ratio of 0.53. For context, a healthy auction has a coverage ratio above 2.0, meaning buyers want twice as much as the government is selling. A weak auction might see 1.8 or 1.6. Below 1.0 means failure. There aren't enough buyers at any price to absorb the supply. The Treasury Department withdrew the auction and announced it would restructure the offering. That's government language for, we tried to borrow money and couldn't. 48 hours later, the Federal Reserve announced it would purchase $240 billion per month in Treasury securities and agency mortgage-backed securities. The buyer that the market couldn't provide would be manufactured from nothing. The mechanism is straightforward, and understanding it is essential. When the Federal Reserve purchases Treasury securities, it doesn't use money it has saved. It creates new money, digital entries on a balance sheet that didn't exist before the purchase. The Treasury gets cash, the Fed gets the bond. The money supply expands by the amount of the purchase. This is what printing money means in the modern system. No physical printing press, just keystrokes that conjure currency into existence. Under QE6, the Fed will create $240 billion per month. That's $2.88 trillion per year. For reference, the entire M2 money supply, all dollars in existence including bank deposits, is currently $21.8 trillion. The Fed is proposing to expand the money supply by 13.2% annually through purchases alone. In monetary economics, inflation is ultimately a function of money supply relative to goods and services. If you increase money by 13%, while economic output grows at 2%, you don't get 2% inflation. You get something much closer to the difference, 11% or more, depending on velocity and expectations. The Fed's own projections show 2.4% inflation for 2026. They're announcing a policy mathematically guaranteed to produce 5 times that figure, while publishing forecasts that ignore the policy they just announced. This is where the lie becomes unsustainable. QE6 isn't a choice. It's an acknowledgement that the Treasury market has lost its natural buyers and cannot function without Federal Reserve support. Japan sold $890 billion in the past 11 weeks. China has reduced holdings by $350 billion over 3 years. The United Kingdom, Belgium, and other intermediary holders are selling. Domestic pension funds are at regulatory limits for Treasury exposure. Foreign sovereign wealth funds are diversifying into gold and yuan. The marginal buyer, the entity that absorbs new supply at the margin, no longer exists in sufficient size. The government needs to borrow $2 trillion per year to fund the deficit. It needs to roll over another $8 trillion in maturing debt. Total annual supply, $10 trillion in Treasury securities seeking buyers. Without the Fed, there aren't enough buyers. The January 17th auction proved it. Every auction going forward will prove it again unless the Fed becomes the permanent bid. QE6 isn't policy. It's the Federal Reserve admitting that the United States government can only fund itself through money creation. When central banks behave this way, history provides unambiguous guidance. Germany, 1921-1923. Hungary, 1945-1946. Zimbabwe, 2007-2008. Venezuela, 2016-present. Argentina, repeatedly. The pattern is identical in every case. First, the government spends more than it collects in taxes. The gap is funded by borrowing. Then foreign and domestic lenders lose confidence and demand higher rates or stop lending entirely. The central bank steps in to purchase government debt, creating money to fund fiscal deficits. Inflation accelerates. The purchasing power of the currency declines. More money creation is required to fund the same real spending. The feedback loop continues until the currency becomes worthless. The United States has reached stage 3. The Fed is purchasing government debt because private lenders won't. The only remaining question is how fast stages 4 and 5 unfold. At 3:47 p.m. Eastern yesterday, 90 minutes after the QE6 announcement, gold breached $4,100 per ounce. By market close, it had reached $4,247. That's a $403 single-day move, the largest in the metal's history. The previous record was $98, set in August 2011 during the debt ceiling crisis. Yesterday quadrupled it. Less than 16 hours after the announcement, the Shanghai Gold Exchange reported that all available physical inventory had been spoken for through forward contracts. Delivery times for new purchases extended to 9 weeks. Premiums over paper prices reached 12%, meaning physical gold costs 12% more than the futures contract supposedly representing the same metal. The divergence between paper and physical isn't a market anomaly. It's a recognition that paper claims denominated in a currency being created at $240 billion monthly are not equivalent to physical metal that cannot be printed. The Bitcoin response was equally violent. $127,000 at announcement, $156,000 by Asian market open. The fixed supply of 21 million coins contrasted against the unlimited supply of new dollars, repriced in hours. These aren't speculative moves. They're mathematical responses to a policy announcement with unambiguous implications. While one side prints, the other side flees. The global response to QE6 confirms that foreign holders understand what the Fed just announced. At 9:15 p.m. Eastern, the People's Bank of China issued a statement, in Mandarin only, with no English translation, announcing accelerated implementation of bilateral settlement protocols with all major trading partners. The statement specifically referenced protection against external monetary instability. External monetary instability. That's central bank language for the dollar is being destroyed and we're getting out. Russia's finance ministry announced suspension of all dollar-denominated bond holdings in the National Wealth Fund. Saudi Arabia's central bank scheduled an emergency meeting for Thursday, the first unscheduled meeting since 2020. Brazil's Banco Central do Brasil issued guidance to commercial banks recommending diversification of reserve assets away from G7 currencies. These responses occurred within hours of the Fed announcement. Coordinated preparation. Simultaneous execution. The BRICS framework isn't a theory anymore. It's operating as a real-time escape route from dollar exposure. The mechanism of hyperinflation isn't mysterious. It follows predictable stages that have repeated across dozens of currencies throughout history. Stage 1. Monetary expansion exceeds economic growth. Inflation rises but remains manageable. This was 2020 to 2023. Stage 2. Inflation becomes entrenched. Workers demand higher wages. Businesses raise prices. Expectations shift from inflation is temporary to inflation is permanent. This was 2023 to 2025. Stage 3. Confidence breaks. Foreign holders sell. Domestic holders seek alternatives. The central bank must accelerate purchases to maintain government funding. This began in late 2025 and was confirmed yesterday. Stage 4. Velocity increases. Money changes hands faster as holders try to spend before purchasing power declines further. The same money supply produces more inflation because it's circulating more rapidly. This stage typically begins 3 to 6 months after stage 3 is confirmed. Stage 5. Collapse. The currency loses function as a store of value. Barter increases. Foreign currencies or hard assets replace domestic money in transactions. Government attempts to impose controls. price freezes, capital restrictions, confiscation, accelerate the collapse they're meant to prevent. The announcement of QE6 confirms the United States has entered Stage 3. The timeline to Stage 4 is measured in months. The timeline to Stage 5 is measured in years, but perhaps fewer years than historical precedent suggests, because information moves faster now, and global alternatives exist that didn't exist for Weimar Germany or Zimbabwe. The trap the Fed has built has no exit. Continuing QE6 guarantees accelerating inflation. Stopping QE6 causes immediate treasury market collapse. Yields spike, interest expense explodes, the deficit doubles, more borrowing is required, which can't be funded without QE. Every path leads to more printing. The only variation is speed. This is what it means when economists say fiscal dominance. Monetary policy no longer serves price stability. It serves government funding needs. The central bank has become an arm of the Treasury, creating money to cover spending that taxation and borrowing cannot. The Federal Reserve's legal mandate is price stability and maximum employment. QE6 violates both mandates openly. Inflation will accelerate. That violates price stability. The inflation will require eventual tightening that crashes employment. That violates maximum employment. The Fed is acting against its mandate because the alternative, allowing Treasury market failure, is considered worse. Considered worse by whom? By an institution that has merged its balance sheet with the federal government's funding needs. The Fed is protecting itself as much as it's protecting the Treasury. The distinction between central bank and government has effectively disappeared. The $240 billion monthly figure tells you exactly how large the demand gap has become. The Fed isn't guessing. They know how many Treasury securities need to be absorbed. They size the program to fill the hole left by foreign selling, domestic reluctance, and failed auctions. $240 billion monthly means the private market is $240 billion short of what the government needs to borrow. Every month. Growing as foreign selling continues. Growing as inflation expectations reduce demand for fixed-rate assets. Growing as the feedback loop accelerates. This number will increase. QE6 at $240 billion will become insufficient when foreign selling accelerates, when inflation erodes the real value of Treasury holdings faster, when the next auction fails even with Fed support because the market recognizes the game. What the informed understand is that QE6 isn't a policy announcement, it's an admission. An admission that the Treasury market cannot function without manufactured demand. An admission that the United States government cannot fund itself through normal channels. An admission that the monetary system has entered a terminal phase that can only end in currency devaluation severe enough to reduce the real value of the debt to something sustainable. The destination is known. The pathway is being walked. The only uncertainty is timing. Physical assets don't require Federal Reserve support. Gold doesn't need a buyer of last resort. Real estate produces shelter regardless of currency denomination. Productive businesses generate goods and services that have value independent of the money measuring that value. The repositioning is already happening. Central banks accumulated more gold in 2024-2025 than any period since 1967. Sovereign wealth funds are rotating out of dollar assets globally. Private wealth, the family offices, the informed institutional investors, the generational capital that thinks in decades, has been moving for 18 months. They're not predicting hyperinflation. They're observing the policy announcements that guarantee it and positioning accordingly. The $100 bill in your hand still spends. The grocery store still accepts it. The gas station still takes it. That acceptance is based on habit and history, the accumulated trust of decades when dollars held value reasonably well. Trust is a stock, not a flow. It depletes slowly until it doesn't. Then it depletes very quickly. Yesterday at 2:15 p.m., the Federal Reserve announced it would create $2.88 trillion per year for the foreseeable future. They announced this because they have no choice. They have no choice because the alternative is immediate government funding failure. They're in this position because decades of deficits, artificial rate suppression, and financial engineering have produced a system that requires permanent money creation to function. That system is now visible to anyone paying attention. The announcement wasn't hidden. The implications are mathematical. The outcome is predetermined by the size of the deficits, the absence of buyers, and the desperation evident in the emergency session timing. The hyperinflation phase isn't coming. It was announced, time-stamped, quantified at $240 billion monthly. The only question is whether you understood what you heard. Benjamin Franklin's face on that $100 bill. He understood something about value and wealth. An investment in knowledge pays the best interest. The knowledge that matters now is simple. What happens to a currency created at $240 billion monthly, And what holds value when that currency doesn't? The answers have been demonstrated across every hyperinflation in history. The pattern doesn't vary because the mathematics don't vary. More units chasing the same goods means each unit commands less. This is not ideology, it's arithmetic. The Federal Reserve just told you they will create $2.88 trillion per year. They told you it will continue as long as conditions warrant. They told you conditions cannot improve without the money creation stopping, and the money creation cannot stop without conditions catastrophically worsening. That's not a policy dilemma. That's an announcement of outcome. QE6, $240 billion monthly, as long as conditions warrant. Forever, in other words. Or until the currency no longer exists in any meaningful sense. The timeline between those 2 points is shorter than you think, and it began yesterday at 2:15 p.m. Eastern, with an emergency announcement that most people heard without understanding. Now you understand. The question is what you do with the remaining time before arithmetic finishes its work, and the gap between official numbers and lived reality becomes impossible to ignore. Reality doesn't wait for understanding, it simply arrives. It arrived yesterday. Most people just haven't noticed yet.